economy for India could look like. And we have with us Aastha Gudwani, India Chief Economist at Barclays, joining us this morning. Aastha, great having you. Let me let me first set the context with regard to India-U.S. Now, while the impact with regard to Nifty and markets was not as much in terms of earnings growth, what does this do to the Indian economy as a whole? Because there's a wider economy outside of the Nifty 50 or the Nifty 500 basket, which very well gets impacted by this trade deal of sorts. What's in it for India, in your opinion, and how is the tilt in terms of the deal that has played through?
Thank you very much for setting that context, and thank you for having me on the show. I think this was one of those weeks where decades happened for India. We had a budget, we had a trade deal, we had an MPC, we had clarification on the trade deal. So just too much happened in just a span of 8 days. You asked a very valid question that there is a wider Indian economy outside of the Nifty 500, and I would like to answer that question straight up. There would have been a drag of about $55 billion worth of exports that we do to the U.S. that would have gotten impacted had this 50% tariff lasted a 12-month period. If you remember, these tariffs became a reality in end of August. Starting September, our exports to the U.S. degrew substantially. It was only in November that we saw some increase of about 1.2 percentage points, but they were down again in December. So what they will add to the Indian economy is what they could have taken away had 50% tariffs on India lasted the whole of 12-month period. The sectors that would have been massively impacted back then were gems and jewelry, leather, textiles, apparel, footwear, home decor, and all such things that you heard Minister Goyal talk about in his press conference when the joint statement came through. So does this add something back? Yes, it does. It adds back to the economy the loss that would have come through had these 50% tariffs lasted a full 1 year period. As you said, it did not show up in Nifty because the sectors which were impacted are more labor intensive and less market heavy, so to say. But I think this trade deal coming through with total tariffs going down from 50% to 18% firmly puts India back in the trade competitiveness play. If you look at our competing trade partners, we are actually better tariff versus most of them. And the most important thing that many of us miss right now is that this deal for India will become effective mid-March. And today itself, the tariffs are down from 50% to 25%. And this 25 will go down to 18 after the interim agreement comes through mid-March. So it is more binding versus the treaties or the trade deals that the other competing nations have seen.
And what about the budget, Aastha? Was there was visible disappointment, at least on the street, with regard to maybe one or two policy changes which came through in the budget. But in terms of allocation, in terms of what's in store with regard to bond yields, did the budget do enough in your opinion? And will the unwind on the bond yield, especially on the delta between the bond and the repo, and the 10-year bond yield and the repo, would that likely unwind as a result of the budget in the medium term?
Great question once again. See, as you said, the proof of the pudding is in eating. We saw stock markets correct by about 1,500 odd points on the day of the budget, and 10-year bond yields opened 5 to 7 basis points higher on Monday. Had the trade deal not come through on the night of Monday, we would have probably seen that. The RBI MPC, as we know, did not offer as much comfort as we were hoping for. Where we sit right now, there seems to be some discomfort with 10-year bonds in India. While the supply is only going to increase, as we saw in the net and the gross borrowing numbers. So I think the net borrowing number for FY27 is at 11.7 trillion. This is just the dated government bonds. There is SDL issuance on top of it. The gross borrowing number is a swooping 17.2 trillion INR because there are about 5.5 trillion of maturities in FY27. There is a 1.3 trillion INR of T-bill issuances. So whatever way you cut it, the supply of bonds is a problem. And we have seen comforting measures come through the RBI through OMO purchases. But we can't have an economy where RBI buys about 50-55% of government bonds every year. That's not durable. And it is precisely for this reason that we thought that in this budget, there will be a structural change in terms of either rationalizing the withholding tax for FPIs to make debt instruments more attractive, or restore the tax indexation benefit for fixed income investors in India who are really just going all over equities, and the AUM for the fixed income funds is not rising meaningfully to keep up pace with the demand for the government bonds. Given that both these things were not addressed in the budget, the disappointment was real and was very visible in the bond yield movement that took place on Monday morning. RBI MPC on Friday just said that they are proactive and preemptive in terms of liquidity management, but there was no mention of OMO purchases. We continue to believe that OMO purchases are going to come between now and the April 8th policy. But all of this aside, the only way 10-year bond yield can now feel better is beyond words. It needed some structural actions in the budget, which unfortunately did not come through. OMO purchases may continue to be one quick fix, but I think until a time we see government bond inclusion, the Bloomberg aggregate government bond inclusion, or a change of heart for the FPIs as far as debt instruments are concerned, there has to be a natural demand that needs to be brought in back.
So, Aastha, therefore, more required, very, very likely. Is this delta sustainable? I'm trying to get to the point. I'm trying to get your view with regard to whether the delta 1 is sustainable. And if not, will it likely unwind to a certain extent, maybe over the next 6 months? Because this will present a very good opportunity for bond investors or investors looking to enter the bond market currently. I'm trying to get a sense whether there is that opportunity available in your opinion.
See, this delta or the spread between 10-year and the repo is a function of where you are in the easing cycle. We believe that the easing cycle is now behind us. December 2025 was the last cut, and we are looking at a prolonged pause all through 2026. While the governor was quite clear when he said that he is in accommodative phase and rates today are neutral or below neutral, and that does offer us some comfort, we would not be too rushed to expect repo rate cut in 2026. With that assumption, the spread between repo and 10-year does not look very off. There are micro market dislocations across points on the yield curve, but since we are really done with the easing cycle, it is not very likely that the spread compresses too much from here on.
And the transmission, Aastha, that's the other big concern, right? The rate transmission through the system, that hasn't really fully happened. And Governor Malhotra spoke about that. He said that there is that concern that rate transmission hasn't happened. How quickly do you expect that to likely play out? Do you expect it to be realistic to happen in a quarter?
Right. In fact, very good point that you raised, that Governor Malhotra also acknowledged it. Not only did he acknowledge it, he said that transmission has to happen not just to lending rates and deposit rates, but also to the money market, corporate bond market, government securities market, which means that he isn't exactly unaware of the way in which this transmission channel to fixed income markets is sort of breaking down. From where we sit, I think bond yields need to fall for this transmission to work its way through. We have seen one-year CD rates go up massively. We have seen money market rates up. The only good thing that's happening right now is that overnight rates and TREPs are actually coming in below repo, which we think is by design because they want the transmission to accelerate. We can't quite put a timeline to it, whether this is going to be in this quarter or 2 quarters, but the fact that transmission to markets beyond the banking sector found such a prominent mention in the post-policy presser makes us hopeful that this transmission is going to play through, or whether it plays through through overnight rates coming in lower than repo or being consistently lower than repo, or through verbal interventions or OMO purchases is for the RBI to decide.
Okay. Aastha, last question with regard to inflation. And of course, Governor Malhotra tweaked the inflation expectations by just 10 bips or thereabouts. But talk to us about the base that we sit at. We sit at a very low base. And therefore, the 4% inflation number, do you believe that there could be an upside risk to this number, if at all, maybe, for example, if the monsoons don't play out as well? And could the upside be material, in your opinion, at all?
The fact that this is one of the last questions that I'm being asked makes it rather clear how big an inflation worry do we have in India right now. See, the thing is that we had unusually well-behaved, or for that matter, unusually low perishable prices pan out through 2025, which added to the favorable base effect which was at play. So it's important to understand why we are where we are as far as inflation is concerned before we try to dissect where we can be. Monsoon in 2025 was not just above normal, it was spatially well distributed, and that had a very sanguine impact on perishable prices. Even if we have good monsoon, which is not distributed well spatially, perishable prices can come under stress. If we have one bout of erratic rains, again, supplies can get halted. So this is going to be a very evolving situation in 2026. But for one to say that 25 was a rare event and cannot repeat itself, I would disagree to that. The reason why FY26 CPI inflation has been revised up by 10 basis points is because there are only 2 to 3 more prints that will come out. But most important thing to note here is that FY27 inflation forecast has been withheld, and rightly so. I'm sure the viewers here February, we'll have the revised CPI series come into play with 2024 as the base year. As that happens, we may be looking at very different CPI inflation numbers. And once that series is in place is when we would like to see whether inflation in 2026 is going to be materially higher than 4%. On the current base, we have inflation rise from 2.1% in FY26 to about 3.8% in FY27, which is still below the target.
Okay. Aastha, thank you so much for coming in and speaking with us. We'll let you go on that note. This has been an excellent conversation, partly because we've had decent time post-policy and post the last 8 days to kind of look at the big picture, but also, of course, having your view on a day like this is really good perspective. So thank you for that.
Thank you very much.
All right. And viewers, what we'll do is slip into a very short break.